So if you want to filter stocks based on some fundamental criteria, here are some interesting ideas. I follow Patrick Walker. Patrick Walker is a veteran trader. He's a veteran CanSlim trader in the US. He's been trading for more than 4 decades now. He has also been a workshop leader, and you can watch all of his interviews online. Fantastic person, very helpful in nature. He's almost a grandfather now, but he has some great ideas based on his experience, based on his rich experience in the US market. So, this is what he recommends if you want to filter stocks based on some fundamental criteria. And this is for positional traders. See, for swing trading, you might look for a tight base and you might want to buy the breakout as long as the stock is showing good relative strength in terms of 52-week performance. There, you might not look at earnings. So, for example, if you're buying some biotech company or some pharmaceutical company, doesn't have earnings, but they're waiting for some approval and they get the approval, or there is some company which is mired in some legal cases and the legal case gets dropped and which is good for the company, then in such cases there might not be earnings on the table, but some good development might propel the stock upwards, and at that moment in time there could be a base. So swing trading is a different style, position trading is a different style. For positional trading, what makes the stock go up is the sales growth and the earnings growth. So swing trading, I would say you would hold on to the stock for 1 or 2 months. Position trading, you might hold on to the stock for 6 months, 1 year, or maybe more. Okay. So if Patrick Walker says that the quarterly EPS growth rate should be greater than or equal to 40%. So what is EPS growth rate? What is quarterly? So let's say we look at June quarter of this year, June 2024. So we have to compare the June quarter results of 2024 with June quarter results of 2023, and you look at the growth. Okay, quarter on quarter, comparing current quarter with the same quarter last year, the growth should be more than or equal to 40%. And or now, if this criteria is not met, then you have another criteria. The quarterly sales growth. Now you are comparing the quarterly sales of June 2024 with quarterly sales of June 2023. Similarly, you will look at the quarterly sales of March quarter 2024 with quarterly sales of March 2023. Okay. So the average growth of these two quarters, okay, should be more than or equal to 40% if this criteria is not met. And if both criteria is met, then it's like the icing on the cake. Okay. That is what Patrick Walker focuses on. That is what he recommends through his videos. At least this is what I have understood by listening to him, by learning from him. This is not the only thing that I have learned from him. I have also learned from him about the 8-day exponential and the 21-day exponential moving averages. So I highly encourage and recommend that you watch his interviews online. You will find 2 or 3 very long format interviews where he talks about everything: risk management, position sizing, uh, buying breakouts, trading psychology, almost everything. So quarterly growth rate 40%, quarterly sales growth more than and equal to 40%, and or this is important. So let's look at this stock. So EPS growth rate Q1, Q2, Q3, Q4. So Q4 of, let's say, Q4 of a particular year, let's say 2018. You will compare 2018 Q4 with 2017 Q4. Okay. The growth rate is 45%. Now, if this number is more than 40%, I wouldn't even look at this. So in this case, the sales growth is minus 22%. See, you see this parenthesis. So even though the sales growth is minus 22%, okay, which means the sales have actually declined. But since there is earnings growth, I would still consider buying the stock. Okay. Next, if I change the numbers, see, EPS growth rate is 22, doesn't meet our criteria. However, if you see the latest 2 quarters, what was the rule? The latest 2 quarters average should be more than or equal to 40%. So if we take the average of these two numbers, okay, That's more than 40%. So I would still consider buying this stock based on Patrick Walker's criteria. Now, this is not 40%, more than 40%, but the average is more than or equal to 40%. So that is what the rule indicates. So that is what Patrick Walker says. Okay. Here is what William O'Neill says. William O'Neill is a market legend. He has more than 4 decades of experience in the market. He used to trade in the 60s, 70s, and the 80s. Even after that, he is the founder of MarketSmith. So, legendary name in the world of stock market in the US. He wants that same growth rate to be more than or equal to 25%. And now, see, in Patrick Walker's case, it was and or. Here it is and. So, which means William O'Neill's criteria is more strict than Patrick Walker's criteria. Although the growth rate required is less, but you need both EPS growth and sales growth. So both the growth rate should be more than equal to 25%. If the sales growth is not more than or equal to 25%, then at least the growth should be accelerating. So let's look at examples. So see EPS growth rate 27%, latest 35%. So both are more than 25%. So William O'Neill would probably consider buying this stock. Now see, this is more than 25%, but here it's not more than 25%. But see, the growth is accelerating. Okay, 7%, 9%, 10%, 15%, accelerating growth rate, at least the latest 3 quarters. Okay, so William O'Neill would still consider buying this stock. Now see, here you have odd earnings growth, odd sales growth because you have negative numbers here. Although this is more than 25%, but there is no consistency in earnings growth. So William O'Neill would feel skeptical about this stock. Here the sales growth is terrible. Sometimes it is minus 5%, sometimes it is 10%, sometimes it is minus 22. Very odd. I mean, if the sales is falling by 22%, how can the EPS grow by 27%? That would raise suspicion in the mind of any reasonable analyst worth his salt. Okay. So this is a stock that William O'Neill would probably avoid. Now, I have just explained to you what Patrick Walker considers as a fundamental criteria. I have also discussed with you what William O'Neill considers as a fundamental criteria, and you can clearly see the difference. Plus, if you read Mark Minervini's book, he has an entire section in his book on the fundamentals. Plus, if you listen to David Ryan, then he will have his own ideas about sales growth and earnings growth because he has his own personal experience. I have my own personal experience. So different people have different experiences in the market, and different people have different criteria that they use based on their prior experience. What I would recommend to you is this. You look at earnings later. First, you look at some basics. Number one, be flexible. Don't be rigid with your earnings criteria. Don't say, I will only buy stocks which are showing earnings growth rate of 40% or more. See, then you are missing a lot of stocks which might have lesser earnings growth but more consistent earnings growth. Okay. So you have to be flexible. So don't filter your stocks based on the earnings. You can check the earnings later when you have your watch list of 4 or 5 stocks for a day, particular day, then you can check the earnings, but don't use earnings as a filtering criteria. Okay, be flexible. Wait for the base to complete. See, irrespective of whether the stock has earnings or not, we need a proper base formation since we are buying breakout stocks. So the stock should consolidate properly. The stock should show tight price action on the right side in the base. Well, price trend, this is not negotiable. The stock should show good price trend, at least 80 or more. The price rating should be 80 or more. That means the stock should be doing better than more than 80% of all the stocks in that particular stock market. So the price strength has to be there. The stock must be in a strong industry group, at least in the top 20% of all the industries in terms of 6-month performance. So if we compare the 6-month performance of all the industries, our stock should be in the top 20 percentile. Okay. Institutional buying should be there. This you can check directly on MarketSmith if the institutional buy rating is A or B. Our stock should fall in that category. If you don't have market smith, then you can check the weekly chart. On the weekly, if you see nice volume coming in as the price is going up, that's called institutional buying. If the stock should have good average volume, set some basic criteria for average volume. So, for example, minimum 200,000 shares traded on a daily basis on an average, okay, on a 50 week simple moving average of volume line, the stock should show good average volume, okay. So minimum 200,000 shares traded on a daily basis. This is something I learned from Patrick Walker. We want to be in liquid stocks, we don't want to be in illiquid penny stocks. And of course the stock should be within 20% of its 52-week high. This is the basic criteria that you use to shortlist some ideas. And once you have that list, and once you shortlist the stocks based on this criteria, let's say you have 5 or 10 stocks for the next day, then you decide on which stocks you want to take a swing trading position, which stocks you want to take a positional trade. And those stocks which you are selecting for position trading, that is where you have to be more strict. Okay, that is where you could use the William O'Neill criteria or the Patrick Walker criteria or whatever criteria that you want to use. But you have to use some kind of fundamental analysis. So, three basic factors in fundamental analysis is sales growth, earnings growth, return on equity. Return on equity should be minimum 17%, 17% as per William O'Neill's criteria. But if you find a stock where, let's say, the return on equity is 15%, but there is consistent sales growth, consistent earnings growth, but it doesn't meet both the criteria of William O'Neill and Patrick Walker, I would still consider buying the stock because it shows good return on equity, it shows consistency in earnings, it shows consistency in sales growth. I might take a small position in the stock since it doesn't meet the hard criteria. Okay, so that is called being flexible. Okay, so don't put earnings filter. Use the basic filters like price strength, industry strength, minimum average volume, institutional buying, stock close to 52-week high, and that's it. And then whatever stocks you get, 100, 200, doesn't matter. Shortlist the stock based on the tight base because this base you can check only on the chart. Shortlist the stock, look at the chart. If the base looks good, then you look at the earnings and the sales and things like that. Then you look at the weekly chart and all those things. You can do as much analysis as you want as long as there is a good base formation on the right side. So this is my little take on how you would filter and how you would approach a particular stock. Thank you so much.